It's Thursday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up, Mike Baudendistel is going to give us a rail intermodal update. But first, we're going to go to Zach Strickland with Carrier Update, brought to you by PowerFleet. Stay tuned.
Hey there, and welcome to your Thursday Carrier Update presented by PowerFleet. I'm Zach Strickland. So hopefully everybody's having a good week so far, coming into the second week of the traditional summer season for freight. We traditionally see freight volumes kind of rise up and start to gradually increase throughout the month of June before peaking right around July 4th, or right before July 4th. And we are definitely in some sort of pattern along those lines, but not quite just yet. I've got the spot rates for the United States pulled up here, the national average for spot rates. So volumes have been increasing. You've been thinking, here comes some tightness, here comes our traditional, summer season. Maybe we'll see if this V-shaped recovery holds true in terms of, what we're seeing in terms of volumes, et cetera. So the blue line right here, national average of the spot rate right now. And you can see that we've actually eclipsed 2019 in terms of the average spot market rate. Just for the time being, about mid-May to the end of May, we're seeing these rates kind of come back into line a little bit versus last year. So last year at this time we had road check coming on. This year we will not have road check. So that did definitely, the first week of June had a big substantial increase in the spot market because capacity came offline as drivers just said, we're not going to drive anymore. Right now, volumes were of course very low, in the traditional sense of, what we see normally in the summer months. So a lot of them just said, I'm going to park the truck, not worry about getting a citation, etc. Well, this year, rates are moving a little bit differently. Normally, you can see the last 2 years, we have this trend of very kind of flat through the month of April into May before starting to increase towards the end of May because of Memorial Day and of course summer seasons. Last year we were very flat throughout the entire month of May. This year, of course, the coronavirus COVID pandemic created a huge dip at the end of April, and they have V-shaped recovered, if you will, for the moment. So we will see. We'll have to watch and see if these rates continue to slowly and increase over time. Not so much on the same pace as we would normally see this time of year. It's been a very slow crawl, but at the same time, we'll have to wait and see how tight things get here moving forward. So, outbound tender volumes. We have now had 2 days in a row of sequential decline off of the peak, which was right around 11,308. Now we were back down to 11,000. Not necessarily a huge decline in volume, but again, we are declining 2 days in a row on the outbound tender volume index, moderating a little bit. We are starting to see some of those volumes kind of pull back. Looking at the last 2 years, line there in green, we're starting to come in line with 2018 again. We actually surpassed 2018 for a little bit. If you connect the two dots between the Memorial Day situation, but 2018 still kind of being the big bellwether in terms of what we consider a very robust season. We'll probably drop below that as 2018 took off in the month of June. 2019, we're doing way better in 2019, something that people may not really understand at this point. Where are we seeing the volumes week over week increase? Still taking some of that market share. Los Angeles, 13.1%, the big performer of the week. So far, Milwaukee, Wisconsin as well at 13%, doing very well. But Los Angeles has been the big market to watch this month. So we need to break this one down. A lot of long haul freight coming out of Los Angeles. Big DC center, as you've heard me say numerous times before. Where are all these volumes going? Well, a lot of these volumes are actually long-haul freight moving across the country, going to some of these northeastern warehouses, southeastern warehouses, into the Midwest. The Midwest has been exploding this week in terms of volume growth, et cetera. So Los Angeles, big epicenter for where that freight originates. But however, we are starting to see growth in the local or the city outbound tender volumes, as well as the mid-haul. So not necessarily a huge amount of freight going across the country like we saw before. So a lot more shorter haul freight moving out of Los Angeles right now. Looking at the reefer volumes as well, reefer volumes are starting to fall off, but van volumes continue to increase. So that short haul freight really driving the Los Angeles market right now, even though it's still a majority of long haul freight, but it is growing on the smaller freight. So that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
I'm here with Mike Baudendistel for this Rail Intermodal update. Mike, what do you have for us today?
So today I'm going to zero in on one of the key intermodal lanes and talk about the competitiveness between intermodal and truck. So on the board here I have rail container volume in blue between LA and Dallas, and then in green and orange I have the truckload volume index. Orange is LA and green is Ontario. And you see some kind of interesting patterns here. Rail volume in blue fell off most dramatically after the Chinese New Year, just with the lack of imports, in between those two, that origin destination pair. And then, it sort of bottomed out in early March. With truckload, it actually bottomed out in sort of mid-April. And you see sort of the pattern there where in April, the rail volume sort of came back sort of slowly and steadily sort of ever since. It's been on a little bit of a rise. With truckload volume, you really saw a surge in May and through June. And so it's kind of interesting. I think as a lot of stores are opening back up, they need those goods that are in warehouses in, say, Ontario, California, need them quickly. So it's really maybe intermodal is not a viable option if you need those high service levels. We're seeing this reflected in the rates. On blue here, have the truckstop.com 7-day van rate between Los Angeles and LA, and you see how much that surged since the beginning of May. So it went from less than $1.25 to $1.93. Meanwhile, intermodal rates do not tend to be as volatile, and you've sort of seen this gap. Putting these on the same chart, this gap open up where intermodal is more than 20% less expensive than truckload. You usually look for about a 15% discount to truckload in order to move something intermodal. So intermodal is looking pretty good on a rate side. So for shippers that have a little bit more time, intermodal looks good on the rate side. We're also seeing this reflected in the tender reject index in that same OD pair. In blue, I have the tender rejection index between Los Angeles and Dallas. In orange, have it for the country as a whole. That lane is usually reflective of the country as a whole, and it is kind of interesting that you're seeing this gap open up a little bit. What Zach Strickland was just talking about, as far as a lot of freight coming out of LA, and we're sort of seeing LA sort of outperform the rest of the market as a whole. Seeing that reflected in the dynamics in intermodal, because that's such a key city for intermodal. And then here we have train speeds for intermodal in the western part of the country in blue, Burlington Northern, in green, Union Pacific. Both of those are at high levels, 37 miles an hour for Burlington Northern. That includes, time in delays. So that's really, moving pretty quickly. And that's one indicator that service is strong, consistent with, volumes still being lower year over year, and the anecdotes that we've heard.
And Mike, this is a little bit different from what we went over Tuesday, correct? When we were looking at some of the rail intermodal data there, we talked about some of the difficulties around the industrial sector. This seems like there's more activity downstream coming from the consumer side of things, and that's what's really going to be pushing volumes here. Yeah, I think the consumer is healthier than the industrial side of the economy. I think on the industrial side, you're seeing a lot of companies conserving cash and wanting to be able to pay dividends and just to make sure that they have enough cash, cutting back on capital expenditures, figuring there's not going to be as much demand, but the consumers still seems to be healthier. And with intermodal rates so low, do you think shippers are going to start to take advantage of this? Yeah, I do. I mean, it's intermodal's come back. You've seen the volume come back some. I mean, certainly, it's the year-over-year change has narrowed. Where now it's down about 10% year-over-year, whereas the rail carload traffic is still down about 20% year-over-year. Excellent, Mike. Thank you so much. Insightful as always, and thank you so much for tuning in. That's going to do for this Thursday edition of FreightWaves Now, but the content does not stop here. We're always streaming around the clock, so check out our FreightWaves TV app on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.